Welcome to Volume 11, Issue 24 of the Milestone Investing Market Intelligence Bulletin. And this week's ex-dividend date is the 13th of June, 2024. I think we should jump straight in. And we will see that this week we have 6 companies. We have Land Securities, RS Group, Compass Group, Intermediate Capital, Scottish Mortgage Investment Trust, and JD Sports Fashion. Between all of them, they're paying these amounts, which represents the total of 654 million. And that represents 0.9% of the total capitalization over here of 71.2 billion. So we're paying out less than 1% in terms of a dividend yield. And the largest of that chunk is this one here, Compass Group, at 278 million. So that's basically what we have for this week. If we look at it from a derivative yield perspective, we're looking at Land Securities 41.5%. For professionals, non-professionals 9.3%, RS Group 21.2% for professionals, 9.7% non-professionals, Compass Group 16.2% professionals, non-professionals 3.7%, and then we've got Intermediate Capital Group 11.9%. Non-professionals 11.9%. I'll stop there. And so we can see they're the main ones. But the two that's above 20% are the top two. RS Land Securities Group and RS Group. So let's jump straight in and see what we can find out about those two. Land Securities Group PLC is a UK-based real estate company. The company builds and invests in buildings, spaces, and partnerships to create sustainable places and connect communities. The company has a portfolio of retail, leisure, workspace, and residential hubs. Its segments include Central London, major retail destinations, mixed-use urban neighborhoods, and sub-scale sectors. The Central London segment includes all assets geographically located within Central London. The major retail segment includes all regional shopping centres and shops outside London and its outlets. The mixed-use urban segment includes its investments in mixed-use urban places. The subscale sectors segment consists of leisure and retail parks. Its properties include Mayfair, the O2, Lewisham Shopping Centre, Dashwood, 30 Eastbourne Terrace, the Zigzag Building, Gunwharf Quays, Buchanan Galleries, and 30 Eastbourne Terrace, among others. Mark Allen is a CEO. Vanessa Sims is a CFO. They pay dividends 4 times a year. And in the last 12 years, had you traded this company for dividends, you would have had 25 opportunities to pick up dividends. In fact, you would have 49 opportunities to pick up dividends. So, if you were to trade in this company in the last 12 years, you would have had 25 opportunities to get your money back within a week. And that's 51% of the time. 14 out of 49, which is 29% of the time, it would have taken you less than a month to get your money back. And 7 times out of 49, 14% of the time, it would have taken you more than a month to get your money back. And in that 12, 13-year window, there were 3 occasions when you didn't get your money back at all. What about going short? 24 times out of 49, you got your money back. In fact, you made money shorting this on day 0, the Thursday. And 23 times out of 49, you made money shorting this on day 1, the Friday. Let's do a deep dive on the numbers. We're looking at quarter 2 for this week. So the previous quarter 2, 2023, 27-day recovery. The quarter 2 before that didn't recover, still hasn't recovered, with 724 days yet, and still climbing. So it fell for 104 days. It's been on the rise for 620 days, and it still hasn't gone back to where it started on the Wednesday, the pre-ex-dividend date. If we go to quarter 2, 2021, 5-day recovery. Quarter 2 before that, in 2020, in fact, there wasn't one because there was COVID. So prior to that would be quarter 2, 2019, which is just here. So we've got 0-day recovery. We've got a 5-day recovery. We've got this one hasn't recovered yet. And we've got 27-day recovery. So we've got 2 within a week and 1 within a month and unrecovered. So based on that performance, I would say that this one is inconsistent and it's not giving you a clear positive picture whether to go with it long, go with it short, or what would you do with it? Let's go short for a second. Q2, day 1, 0.1%, and then it went on to make a larger percentage. But that was like after a few days, 25 days to be exact. This one, first 2 days, very little. And after that, you went on to make some more returns. Quarter 2, first day, -2. Friday, you made 13%. So that was better on that one. And then quarter 2 here, obviously all terrible because it recovers too quickly. So even this one is not giving you consistent rewards when shorting. It's not guaranteed immediate rewards. So this one's a bit we have to leave that one alone and say we don't know. Let's see if we can find something a bit more consistent than this one. Let's look at the revenue. Revenue for this company, 741 million, falling to 635 million, raised to 679 million, then 791 million, 824 million. So you see it starts to rise from 21 onwards. Profits went from negative 837, and then it went further down, negative 1.4 billion. And then it went up into profits, 875. And then it went back into losses, 622 million. And then it went up a bit to 341 million losses. I'm not going to look at the profit margin on this one because it's an investment company. You can sometimes get profits being larger than turnover, and so you kind of get a weird ratio being formed from that. If we look at the capitalization, we can see that the company's worth here. This is now to buy the whole company in the stock market, 4.9 billion. The balance sheet, net assets, is 6.4 billion. So it's basically trading 0.7 times book value. And we can see the P ratio is obviously negative numbers. But look at the balance sheet. The balance sheet goes from 8.8 billion, 7.2, 8 billion, 7.1, 6.4. So we've got a declining balance sheet, but the balance sheet is higher value than the market value of the company. So we can see here that the balance sheet is double market value. So it's half. It's trading at half the balance sheet here. You got a value of 5. It's been sold in the stock market for 5.7 billion. Balance sheet is 7.2. Now the reason why I'm bringing this up, because you could literally spend 4.6 billion buying this company and sell it, get rid of all the assets and sell it for 7 billion, make a profit. You can make a 2 billion profit just by literally selling what's on the balance sheet. So this one's, you know, a good value for money from an asset point of view, but from a point of view of profit, it's in bad shape, this one. Share price, 2018, we saw the latter part of the year it was falling. 2019 was zigzag up, down, up. 2020, first quarter was down for the COVID, then it kind of zigzagged sideways. Then it started to gently move up in 2019. It gently moved down 2021, gently moving up. 2022, it was drifting down for the first 3 quarters. Last quarter, it bounced back up a bit. Same again in 2023. The first 3 quarters was drifting down with the last quarter boost. And then 2024, moving sideways. RS Group is a UK-based company which is a global omni-channel provider of product and service solutions for designers, builders, and maintainers of industrial equipment and operations. The company segments include EMEA, Americas, and Asia Pacific. It stocks more than 750,000 industrial and electronic products sourced from over 2,500 suppliers and provides a range of product and service solutions to customers. Its product solutions include automation and control, mechanical and fluid power, electronics, maintenance and safety and protection. Its service solutions include design solutions, customer order solutions, procurement solutions, inventory solutions, maintenance solutions, safety solutions, integrated supply solutions, and ESG solutions. RS Pro is its own brand product range. Its OKdo brand is a technology solutions business focused on single board computing, SBC, Internet of Things, and education. Better World is its sustainable product range. Simon Price is CEO, Catherine Ringrose is the CFO. They're number 110 in the FTSE 100. They got a valuation of 3.3 billion. And in the last 6 years, had you trade this company for its dividends, you have got 13 opportunities to do so. Five times out of 13, had you gone long, you got your money back in a week, which is 38% of the time. 4 times out of 13, had you gone long, you got your money back in a month, which is 31% of the time. And 4 times out of 13, which is also 31% of the time, it took you more than a month to get your money back. And in that 6-year window, there were no occasions when this company did not give you back your money. What about going short? 6 times out of 13, you made money short in this company on day 0, Thursday, and 8 times out of 13, You made money as it fell some more. We did 62% of the time, and that was on the Friday. I deep dive these numbers. We got the final coming up. So the previous 2023 final took 182 days to recover, 182 days. This was 21 days. This is 15 days. And so if I just go back over these ones and look at what it looks like from here, from a shorting perspective, we're looking at making a profit, then a loss, and then a profit. So this one was bouncing around a bit. 2022, shorting this would have been fantastic because it fell heavily. 2021, shorting this was fantastic also. It fell strongly. And so one could argue that shorting this company is profitable. Let me just double check the summary of all of this. Okay, this one is profitable shorting it. We've got revenue of let's call it 2 billion, rising slightly, 2 billion, rising again to 2.6 billion, rising again to let's call that 3 billion, and it fell slightly to 2.9 billion. Profits went from 200 million, fell to 161 million in 2021, rose to 302 million 2022, then 372 million 2023, and it fell again to 249 2024. So from here, you got rise and then drop, and then from here, you got rise and then drop. If I look at the profit margin, we got margins of 10.2, which is a conversion from revenue to profit at a rate of 10.2. It fell to 8, it rose up to 11, then 12, and then fell back to 8. So we can see that 2021, we had challenges, and 2024, we are appearing to have some kind of challenge. Now, this could be the mere fact that you've got reducing revenues and cost of living rises, natural cost of living rises. Now, that have the effect of rising expenses against falling revenue will give you a smaller profit. I want to look at the capitalization right here. We have a value of 3.4. We've got net assets of 1.4. This company is trading at 2.4 balance sheet. If you look at the previous times, it was 3.2 balance sheet, 5.2 balance sheet, 4.6, 3.2, 2.4. This company from here is getting more and giving you more and more value for money. It's getting cheaper relative to the balance sheet. Compare that to the revenues. So compare the price to earnings, and we've got P ratio of 19, 15, 22, 36, 15. The range I'd like to pay attention to is between 13 and 20 for the FTSE 100 companies. That fits in that range. So does that, and so does that. So this company at the moment is basically value for money. Share price zigzagging here 2018, slightly rise 2019. From quarter 3 to 2 onwards, 2020 was rising, kept on rising in 2021. 2022, we saw the peak, and then it started to drop off, back up again, drop off. 2023, we saw the share price again sliding back down again. And 2024, again, we can see a downward price correction, which might account for the value for money proposition going on here. Compass Group. It's a non-trading investment holding company. The company is engaged in providing food and support services. The company has 3 segments: North America, Europe, and the rest of the world. The North America segment includes the United States and Canada. The Europe segment includes the UK, Finland, and other. The rest of the world segment includes Japan and other. The company delivers services in sectors including business and industry, healthcare and seniors living, education, defense, offshore and remote, and sports and leisure. It operates at various client locations around the world, from hospitals, schools, and oil rigs to corporate headquarters and entertainment venues. Its support services include cleaning in hospitals, reception service at corporate headquarters, managing remote camps, grounds and facilities services at schools and universities. Its subsidiaries include Compass Group Australia, Property Limited, and Compass Group Belgium, NV. Dominic Blake is the CEO, supported by Palmer Brown in the role of CFO. They are number 16 in the FTSE 100 with a valuation of 37.2 billion. In the last 13 years, had you traded this company for its dividends, you would have had 26 opportunities to do so. 11 out of those 26, which is 42%, had you gone long, you got your money back within a week. 12 out of 26, which is 46% of the time, you got your money back in a month. And 3 times out of 26, 12%, it took you more than a month to get your money back. And in that 13-year window, there were no occasions when this company did not give you back your money. Going short, 15 times out of 26, 58% of the time, you did well. Day 0. And 13 times out of 26, which is 50% of the time, again, you also did well. If I deep dive these numbers, interim, so the previous interim was 20 days, 14 days falling, 6 days rising. Prior to that, 2022 was 33 days recovery, 15 days falling, 18 days rising. And then the one prior to that, so 2021 interim and 2020 interim, they weren't paying dividends. Then you got one before that, now 2019 interim, 13-day recovery, 1 day falling, 12 days rising, and I'll leave it there for now. So we've got 2 weeks here, we've got 1 month here, and we've got 3 weeks right here. 3 weeks, 4 weeks, 2 weeks. It's how long it takes to recover. From a shorting perspective, we have inconsistency here. We have excellent returns here. And we have excellent returns here. So we can see that the majority of the times, shorting this company is very, very profitable, except for in 2023. So basically, we've got some inconsistency here. Previously, this was done when you made a lot of money shorting this, and then in the last occasion, it was kind of not so profitable shorting this company. The fundamentals for this, 2019, we've got 25 million, 24.9. Revenue falling to 19.9, falling to 17.9 billion, rising to 25.5 billion, rising to 31 billion. So you see a nice V-shape drop. It hits the bottom of the V in 2021 and bounces back up again. Revenue, which I beg your pardon, profit, 1.5 billion, falls to 210 million, rises to 464 million, rises to 1.5, rises to 1.7. So now you've got a tick shape. hits the low point here, like a Nike tick, and then starts to rise from there. Profit margin. We've got single digit margin, which is a tough challenge. We got 6% return here. We got 1% here, 2%, 5.8, 5.6. It looks to me like this company normally delivers 6% profit margin, and twice it had 2 years where it kind of struggled with falling revenue, rising prices. If I look at the capitalization, we've got 34.9 billion value stock market, and that's set up against 5.6 balance sheets. So this is nearly 7 times balance sheet. If I compare revenue to earnings, now we're looking at these numbers here. Got 27, 29, 76, 146, and 29. Everything is above 20, so you might argue these prices are a bit on the premium side. Share price is rising here. It fell in 2020. And then after that, it's just been soaring. 21, 22, 23, and then slowing down slightly, 24. Okay. Yeah, Compassus is a little bit on the pricey side. And we've got 2 occasions when you did well shorting, but it's not consistent. Intermediate Capital is a UK-based global alternative asset manager. The company manages capital on behalf of its global client base, principally across long-term closed-end funds. It provides various capital solutions for corporates and owners of real estate and creates value for stakeholders, shareholders, and communities. The company operates through 2 segments, the fund management company and the investment company. The company operates across 4 asset classes, which include structured and private equity, private debt, real assets, and credit. Its structured and private equity consists of providing structured and equity financing solutions to private companies. Its private debt consists of providing debt financing to corporate borrowers. Its real assets consists of providing financing solutions in the real estate and the infrastructure sectors. Its credits include investing in primary and secondary public credit markets. I think it's Benoit Durteste, CEO, and David Bicarigi, CFO. I'm not sure how you pronounce his last name. Okay, this company, International Capital Group, is 62 in the FTSE 100. It's got a valuation of 6.6 billion. And in the last 8 years, how you trade this company for its dividends, you would have gotten 18 opportunities to do so. 7 times out of 18, 39% of the time, you made money trading this in week 1. 4 times out of 18, which is 22% of the time, you basically got your money back in a month. And 7 times out of 18, 39% of the time, it took you more than a month to get your money back. And in that 8-year window, there were no occasions when this company did not give you back your money. What about shorting? We've got 13 times out of 18, which is 72% of the time, done well on day 1 or day 0. 11 times out of 18, 61% of the time, you did well on Friday. So at 72 compared to 39, this one looks like you should be leaning short. Let's confirm. We have final 35-day recovery, 43-day recovery, 42-day recovery. If I were to short this, I made money in the short term and the long term. I made money short term and the long term. And this one, I made money on day 0, lost it on day 1, Friday, and then it kept on falling. So I was good after that. And then this one, again, more profit. So this one's basically good for going short. Intermediate Capital Group, good for going short. Most of the time. Fundamentals. 414, rising to 829, rising to 982, falling to 639, rising to 650. Profit, 115 million, rising to 510 million, rising to 565 million, falling to 521 million, rising to 531 million. Profit margins, 27.7, rising to 61.4, falling to 57.6, falling to 39.3, rising to 55.9. So we got double-digit profits here, and we have declining revenue from here to here. Sorry, declining margins, beg your pardon. So you got declining revenue, well, up and then down. You got declining margins right here. And then revenue rises here. Profits rise here. And your margins rise also. If I compare, let me look at P ratio for a second. P ratio, we're looking at 13, 16, 10, 12, 23. Anything between 13 and 20 is normal. And we're basically normal, cheap, normal. If I compare the capital, the value of the whole business, and I compare that to the balance sheet, the net assets, we're looking at this. We're trading at 2 times book value, 3.3 times book value, 2.6 times book value, 1.7 times book value, and 2.7 times book value. And the share price has basically been sagging up and then down for COVID, up after that, sideways for the latter part of 2023. It fell in 2022, and then 2023 was relatively flat, and then the last quarter started to rise, and it's been rising ever since. Okay, that's all I'm going to share with you for these ones. And if I take you to the summary for the ones I've covered so far shows that RS Group, good for going short. Intermediate Capital, good for going short. Scottish Mortgage Investment Trust, which I haven't done, 89, good for going long, through 1-day recovery on average. JD Sports, good for going long, 3-day on average in the last 3 years. But if we look at the ROI, very, very thin. Small ROI, so it's not really that good. And then that's basically it. Let's quickly go to what's coming up next week. Next week, we've got 5 companies. We've got United Utilities. We've got Persimmon, 3i Group, Experian, and Airtel Africa. Words of wisdom. Financial fitness is not a pipe dream or a state of mind. It's a reality if you are willing to pursue it and embrace it. Wise words from Will Robinson. And that's all for this week. Happy investing. Take care.